Okay, hello everyone. In this video we will talk about the mechanics of option markets, and we will start first by a brief description of different terminology here for the option types. First of all, we have the definition for a call option. So in this case, we have an option to buy the underlying asset. So whatever we define this option with respect to an underlying asset, that will be specified on the contract, the option contract. And in a call option, we have the option to purchase this asset that is specified. And in a put option, we have the option to sell, okay, again from the specified price. And there is also a maturity date of these contracts. And if we have a European option, then that means we can exercise our right to buy or sell at the end of the maturity only. Okay, then this is called as a European option. But if we are flexible and if we can exercise this option to buy or sell the underlying asset until any time until the maturity, then this is called as the American option. And we have different option positions that are given here. As we described, we might have a call option or put option. In the call option, we have the right to buy the underlying asset. In a put option, we have the right to sell the underlying asset. So if we are taking a long position, so we purchase this contract. If we are purchasing this contract, then we have a long position. It can be a call or it can be a put option, but the important point is that we are the buyer of this contract in a long position. But if we are referring to the short position, then that means we are the writer of this option. So we are writing this contract and we are selling this contract to another party. And in this case, we are actually selling this right to another person by designing this, or by, it's not designing, but actually by selling this contract. Here we can see the profit and loss graphically. Assuming that we have one European call option, so we are buying, let's say, a European call option, and the option price is, let's say, is $5, strike price is $100, and let's suppose the option life is 2 months to mature. In that case, first of all, we can draw this graph, and we should note that the strike price, we will usually denote this by K, that is given as 100. Okay, so 100, as you see, is here. That's our K, basically. So if we didn't think about the price of the option, actually our payoff will be like this. So this will be our payoff, not including this premium we paid for purchasing the option, that is $5. So since we paid this $5, this curve will shift down by an amount of $5 here. Okay, so it will be shifted down and it will, correspond to this line graph, this piecewise linear graph. Okay, and that's because now we are considering the profit and loss, which is including this premium of $5 we paid. And as you see, it is, if we have a European call option, remember we have the right to buy this underlying asset. And if the underlying stock price is above this strike price of $100, so we will have a gain in the region here, okay? And reducing the premium of $5, then basically you can see from $105 here, we are actually making a positive profit. So if the stock price, the terminal price of the stock is above $105, so this corresponds to 105 here. Any price that is above this 105, we are going to make a profit because the strike price is 100, so we have the option to buy this stock from 100, although the terminal price is actually above this $100. So this will be a gain for us. But if the stock price at the maturity is below, if it is below this $100, then our payoff is zero, and our profit and loss, basically we are making a loss because of the $5 premium that we paid. Now, in a short position, if we are the writer of this call option, then we will actually have the mirror image of the payoff here. So again, ignoring the premium, that this time we are receiving this $5. So this is an income for us because we are writing the option and selling to another party. In that case, we will be receiving this $5 premium as as the party that we sold this contract. So for the moment, if we ignore this $5, then we can see that this is going to be our profit and loss. Sorry, this will be our payoff. Let's call this. This is the payoff here. And then we will now shift this curve up by $5 premium that we are receiving. Okay, and if the final terminal stock price is below, if it ends up below the $100, the other party will not be able to exercise this option because there is no gain, and then we will basically remain this $5 as our profit as we charge for this contract. But if the stock price ends up above this $100, then we will be making a negative payoff or a loss basically. And the higher the final stock price, the bigger is our potential loss. What about a put option? If we are in a long put position, that means we have purchased a put option contract. And again, now in this example, the numbers are slightly different. The price of the option is $7. Strike price is $70. So here is my strike price. If I have a long position, that means I have the ability to sell this underlying stock from $70. So if the final maturity price is below this 70, I will be making a gain because I'm selling from a higher price, which is 70. Then actually for this region here, as long as, let's say the stock price in an extreme situation went all the way to zero, how much payoff do we have? We are going to have $70. So actually we will have this this line here, okay, as our payoff. That will be our payoff. But since we paid for the $7, it is going to be shifted by the $7 because we are reducing the premium we paid from our payoff. And then that will give us the curve that is here, okay, that basically gives us the profit and loss situation depending on the terminal stock price. And since this will be shifted by $7, this will correspond to this $63 here. And if the price is below this $63, then we will actually have a positive profit in a long put position, I mean, for the given strike price and option price in this example. And now, if we have a short put position, then we are the writer of a put option in this case. And as you can see, if the stock price is below $70. This is a loss this time for us because the holder of the option is making a gain, which is a loss for the side which is selling this contract. And ignoring the premium for a moment, if we ignore the premium, then our payoff function will be something like this, okay? Ignoring the premium we received this time. But since we are selling this position, which is contract, then our curve is shifted by this $7 here. Okay, so that will be shifted up by the premium that we are receiving as the seller of this option. So here you can find all 4 different situations if we have position in a call option or put option, and it can be a long position or it can be a short position. So if we have a long position in a call option, so this is the long call case, we have our payoff like this as we discussed, because we are holding this option, so we have the right to buy this underlying stock from the price K, and if the maturity price is actually above this case, you have the right to purchase a more expensive asset from a cheaper price, which is going to give you a profit or positive payoff, of course. Now, if you have a short position, then this is the short call, then it will be the mirror image with respect to the x-axis. Now, our payoff is opposite to what we have seen in the long call position. And then if we have a put option, if we have purchased a put option, then this is going to be our position. And if we have a short position in a put option, then we are going to face this payoff. If the stock price goes down, we are making a loss because we have sold the right to buy, the right to sell this asset from the strike price K. So assets underlying exchange traded options. There are various types of assets that are utilized in option contracts, and these are for exchange traded options. Of course, there are OTC traded options, over-the-counter market options, and these can change a lot. I mean, you might have options on stocks, on foreign currency, stock market indexes or indices, and like futures. We can have, for example, options on various future contracts. It might be like commodity futures. Okay, we might have the options on oil futures. These type of underlying assets are quite common. And in the specification of exchange traded options, there are various things that must be specified, such as the expiration or the so-called maturity, or we can also call this as the exercise date. And then we have the strike price that defines the price that we can buy or sell this underlying asset. That's the agreed on the contract. And then it must specify whether this option is a European or it's an American option. This must be written or specified on the contract. And also the option class must be specified, whether is it a call option, do you have the right to buy this asset, or you have the right to sell this asset, as in the case for a put option. The terminology again that is used to describe whether the stock price or the underlying asset price is above the strike level or is it below the strike level. If the stock price is traded at exactly the strike price, then this will be called as the at the money option. So in that case, strike price K is basically equal to or very close to the current stock price ST. Or if we have an in the money option, then that means ST, for example, for a call option, if ST is greater than the strike price, that means the option can already be, if we exercise it now, it is going to have a positive payoff. So it is in the money in that sense. Or we might have an out of the money option, which means basically ST is less than K, to describe that if we exercise this option, let's say this is a call option, and there is no positive payoff. And this option class, as we described here, we might have the call option or put option that defines the option class. Option series, we have various types of option series. Intrinsic value, that's basically the value that we have as if we exercise it right now, what will be the value we get from this payoff. There is also the time value because of the discounting. If we have a future gain or loss, basically that monetary amount will be discounted in time. And there are also various details, such as if the underlying is a stock, then the stock might have some dividend payments, or it might have some splits. So in a stock split, for example, one share might become two shares. Okay, and then respectively the price, if we have one share splitting into two shares, that means, let's say the stock price now is $100, and immediately it will become $50 in the case of a split. Or if we have some dividend payment with a certain percentage of the capital of the stock, this company, then this will also imply a reduction in the stock price of this company. So these adjustments also need to be done to reflect the changes. And in this case, in our example here, if we have n options with a strike price of K, let's say, no adjustments are made to the option terms for cash dividends. And when there is an M for M stock split, the strike price is reduced to M times K over N. So for the stock split, as you see, strike price is going to be scaled proportionally, and the number of options is increased to n small n times n over m. So here n describes the number of options that we hold. And stock dividends are handled in a manner similar to stock splits. Here there are a few examples here. If we consider option to buy, let's say 100 shares for $20 per share in this call option, then how should terms be adjusted if we have a 2-for-1 stock split? And you can answer this question. If we have 100 shares for $20 per share, so here the strike price is $20. So we have a call option. We have the right to buy this underlying asset, 100 shares, from the strike price K equals to $20 per share. So in a 2-for-1 stock split, that means one share will become two shares. And in that case, your stock price will be reduced by half. And this K will also be adjusted to, if we call this as K star, new K star is going to be $10, and the stock price will be halved. And then the number of shares will be multiplied by the same ratio, which is 2 for 1. So the number of shares we have written this option will become 200. Okay, the number of shares. For a 9% stock dividend, we can apply the same logic. So if we have 5% stock dividend, you can immediately think that this dividend will cause the stock price to go down by 5%. So basically 100, you can think this as the stock price going down. So in this case, we have 1/2 in the 2 for 1 stock split. But in the dividend case, we can think of this as the 100 stocks becoming 105 stocks. Okay, so that will cause a 5% decrease in the price of this stock. So that 5% should also be reflected in this K. So we also expect a 5% decrease in the strike price. So this will also go down by 5%, and the number of shares will go up by this 5% as a result of this scaling. There are market makers in various exchanges to facilitate options trading, and basically a market maker's role is to quote for bid and ask prices whenever they are requested. So they will be providing this liquidity in the market as writing the bid and ask prices. So the market maker doesn't know whether the individual requesting the quotes wants to buy or sell. Similar to the futures markets, in options trading, there are also margins that are required when options are sold. That's because, as you have seen, when we take a short position in a call option, actually the downside risk can be very large. Our potential loss can go to minus infinity, at least theoretically. Therefore, there should be some strict requirements for avoiding a systematic default in the market. So when a naked option is written, the margin is the greater of these two quantities. A total of 100% of the proceeds of the sale plus 20% of the underlying share price less the amount by which the option is out of the money. So this will be the margin calculation, and the second quantity that we will take the maximum, a total of 100% of the proceeds of the sale plus 10% of the underlying share price. This will be calculated, and we take the maximum, whichever is greater, that will be required as the margin for keeping this position, for this naked option position. So there are various, of course, regulations, and these depend on the different exchange, different markets will have various restrictions or regulations, which is beyond our topic for today. There are also so-called warrants. These are options that are issued by a corporation or a financial institution. So these are basically options, but these are issued by the corporation or some other financial institutions. And the number of warrants outstanding is determined by the size of the original issue and changes only when they are exercised or when they start to expire. The issuer settles up with the holder when a warrant is exercised, and when call warrants are issued by a corporation on its own stock, exercise will usually lead to new treasury stock being issued. And there are also other types of options. So these are more special types, such as executive stock options. These are actually used as a remuneration or to give incentives for the executives of a company because as the price of the company gets higher, the executive will have he or she will have a positive profit if exercising these stock options. So these are usually at the money when issued. So as the price goes higher, the benefit of the holder of this stock option will be greater. And when options are exercised, the company issues more stock and sells it to the option holder for the strike price. They become vested after a period of time, usually from 1 to 4 years, and they cannot be sold because these are specially designed to give incentives for the managers or executives of a company. And they often last as long as 10 or 15 years because we want the managers to have these incentives for long periods and carry the company forward as long as possible. Now, accounting standards require the expensing of executive stock options. Accounting standards, of course, depend from country to country, so we shouldn't generalize this to everywhere globally, but in various markets, of course, this is true. There is also convertible bonds. These are actually regular bonds that can be exchanged for equity at certain times in the future, according to a predetermined exchange ratio. So, how many bonds will be converted to exact number of stocks? This is determined on the contract as the so-called exchange ratio. And very often a convertible is callable. The call provision is a way in which the issuer can force conversion at a time earlier than the holder might otherwise choose. So this is a bit more like a special to these type of bonds. Basically, the call provision is a way in which the issuer of this convertible bond can force a conversion to the holder. Okay, so this is opposite to the traditional or conventional options we described earlier. So these are the all various kinds of options that are traded, and we discussed briefly what are the payoffs and how these options will be used in practice. So thank you for watching.